Latest U.S. inflation report shows that while consumer costs are easing, it's going to take a while to get back to the Fed's target range. Joining us now for more on what it means for rates and the fixed income space, Hafiz Noordin, portfolio manager with TD Asset Management. Great to have you back on the show again.
It's great to be here.
It's an interesting report because, of course, the market reaction has been mixed, trying to decide what to do with it. It wasn't very dramatic, but the big takeaway I guess I had, and I think others did too, and I wanted to get your opinion on, is it seems like this is a fight that's going to take a while. We know that, but there's nothing too dramatic here.
For sure. And, I think what's interesting going into this particular CPI print was that what the theme that started to take a bit of a hold in the market and that Jerome Powell started to put forward was this idea of disinflation. This starting to get kind of sanguine about this idea that yes, inflation is going to come down. But for those who were going into today, hoping for, in line or maybe a bit of a miss to the downside, didn't get that. We're disappointed. It was an inline print in terms of the month over month, 0.5% on a headline basis, 0.4% on a core. But when you feed that into the year over year basis, it was a bit of a beat to the upside, 6.4 on a year over year for the headline CPI versus 6.2 expected by the market. And on core, 5.6 on a year over year versus 5.5 expected by the market. So I absolutely agree. The broad theme of inflation decelerating is certainly there compared to last year, but it's going to be a bumpy ride.
I like the chart that we were just showing the audience in terms of where we were in inflationary pressures, and indeed we have come off of those highs there as we're there between core and headline. But when you talk about that sweet spot, which is that dotted line along the bottom, that 2%, we obviously have a way to go. I know we don't have a crystal ball, but how long could it take us to get there?
Well, I think one of the big forward-looking indicators that we have to factor in, and that what the market has been doing, is shelter prices. It's about 40% of CPI. And so what the market has generally been a bit more comfortable with is this idea that rent prices, which are a good forward-looking indicator, as well as housing prices themselves, do point to this idea that the shelter component of CPI, which lags a lot, it's very slow moving and it's very lagging compared to real-time data, that should continue to chug down. And so that's kind of a known part of the deceleration story. The other part that's known is goods prices. So we know that we had this big, sort of impact from supply chain disruptions over the post-pandemic period, as well as higher commodity prices, generally speaking. And so that really had this, big impact on goods prices over a couple of years. That's now really come back towards more of a normal environment where supply chain is really not an issue anymore. So that's what's known, but what's unknown is the wage story. And so for the rest of the services bucket, which is outside of housing, that's the part that's really sensitive to wages. And I think what's the pace of how we get to 2% really depends on, do wages sustainably start to come down from their currently high elevated growth rates?
Obviously, the average person isn't enjoying these price pressures. At the same time, as investors, the reason why we're so keenly interested in this is, of course, what does the Fed do with this information? What is for a while there, it felt like the bond market was fighting back against the Fed. You get Chairman Powell, as you said, talking about disinflationary pressures taking hold, but we need to get rates even higher and hold them for a while. The bond market's, you'll be cutting before the end of the year. Yeah. Is that story starting to change?
Yeah, and in fact, the Fed's actually been almost kind of winning that battle a little bit in that we're seeing market pricing for this year starting to get closer to the dots, and the dots were showing that stable rate at around the high 4s, close to 5. And so that's where the market has started to move towards, and is now actually moving further than that a little bit, in that we're starting to see pricing in for 5.25% policy rate for the US, even early signs of getting to 5.5%. And so I think that's where there's still, I think, this price discovery, so to speak, where it's going to be data by data point. The jobs number kind of kicked it off a couple of weeks ago, being very strong, showing that resilience in the labor market. Today's print is helping to accelerate that further, to show that it's going to be a slow, a slow move back to 2%. And I think what's probably the bigger and more important story is not just about is inflation coming down, but what is the floor? Is 2% really where we're going to land? I think there's just a lot of uncertainty around that. From some of the work that we do, that's not necessarily a done deal. 3 to 4% is reasonable given the trends right now in housing inflation, but there's just a lot of price discovery around that trend.
So when it comes to the Fed funds rate, if we do end up at a higher endpoint, the terminal rate is a little bit higher than we thought perhaps only a couple weeks ago or a couple months ago, and then indeed the Fed does stay there once they get to that point and they don't cut rates before the end of this year, how does that set up fixed income for this year?
Well, for the most part, the market's already kind of moved in that direction. So we have seen, after an initial rally in bonds to start the year, we've seen a bit of a pullback in bond yields over the past few weeks. Part of that has been that repricing of the terminal rate for this year. But we still do see in market pricing for rate cuts next year still being fairly aggressive. So there's still potentially some room to go if the inflation data stays firm, or if jobs data continues to be very strong. We could see a further, pulling back of some of those rate cuts that are priced in for next year. That would primarily impact the short end and the sort of 5-year point of the curve, because that's the most sensitive to the Fed's policy rate and the expectations of the Fed policy rate over the next couple of years. For longer dated bond yields, not necessarily impacted as strongly. We could still see yields going higher at the long end, but that'll be more sensitive to expected growth outcomes. So if we think that the market expects more of a chance of a recession to happen because the policy rate has to be higher for longer, then we could actually see long bonds stabilize and potentially even decline if we're getting into that part of the cycle.
Is part of the different story in the bond space this year, even though we're still unsure about exactly where we end up with central bank policy and inflation, is the fact that they're actually showing us some pretty attractive yields for the first time in a very long time.
For sure. I mean, it's almost double compared to last year, and so your starting point as a fixed income investor is still that very high level of income, 4 to 5%, depending on where you're on the curve, and then at the same time, if you're getting that duration or interest rate risk in your portfolio from being a little bit out the curve, that helps to provide, in a recessionary environment, a boost to your total returns if yields do then start to come down. So definitely the risk reward has skewed much more in favor of positive total returns for fixed income. Still do have to be mindful that there'll be volatility along the way with the incoming data.